we all assume that entrepreneurs understand their financial statements, right? I mean, you run a business, I always used to assume that. I figured it was one of my key responsibilities to understand my financial statements. And when I started coaching entrepreneurs and spending more time around them, I realized very rapidly, 7 out of 10 entrepreneurs, they can't read a financial statement, let alone understand it. Balance sheet, forget it. That might as well be voodoo. And cash flow statement, they kind of get because it comes in and out. But most entrepreneurs look at their bank statement and the balance in their bank accounts as their kind of metric of success or failure. And that's a really dangerous way to run a business. So I believe it's entrepreneurs' responsibility to get themselves super educated on the financial side, the financial statements of a business. I could go into a 2-hour long rant about how bad GAAP accounting is and how terrible it is to use to run a business. And there's a lot of problems, but knowing the problems, understanding how financial statements work and how cash moves through a business is really, really important. But there's a very specific thing on the profit and loss statement that is maybe one of the most misunderstood and I believe the most important single metric, even more important than net income and EBITDA or profitability, and that's gross margin. And when we talk about gross margin, we mean the incremental cost to actually provide a product or a service to a customer. And you look at gross margin as a percentage of revenue. So let me give you an example. Let's say you sell a skateboard for $100 and you have a skateboard shop and you buy that skateboard. Let's say you make the skateboard yourself in the shop and you have to buy the board from a manufacturer and the board costs $10 and you have to buy the trucks and the wheels and all the other stuff. And let's say they cost $10 as well. And then you've got to pay some labor to put it together. Let's say that's another $10. So that skateboard costs $30 to manufacture. And then you have to do shipping to a customer. Let's say it costs $10 to ship it. By the time you're all done, all the variable costs, all the costs that go into basically providing that skateboard to the customer is about $40. You sell it for $100, it costs you $40. You have $60 in what's called gross margin left. So 60% of the $100 is gross margin. Now, that $60 pays for the electric bill, it pays your salary, pays for, the rent of your shop, all the other things. So it's not the profitability of the business, but it's the incremental value that's created by one additional sale in the business. So nobody really, well, I shouldn't say nobody. A lot of entrepreneurs know generally, if I buy it for $40 and I sell it for $80, that's double, that seems about right. Or I sell it for $100, that's better than double. But they're not looking at that percentage of sales to the direct costs. They look at their profit, they look at their bank statement, they look at cash flow, but they're not focused on that. And the danger in doing that is, let's say you want to have a sale and you want to sell the skateboard now for $80. So you've taken $20 off the top. The problem is you still have the $40 cost to manufacture it, put it together, buy the parts and ship it out. So your gross margin went from $60 to $50. Maybe you'll sell a lot more skateboards and that's great. But if the skateboards that you sell, because that $20 that you took off the top goes right to the bottom line. So 80 minus 40 is only $40 of margin versus the 60 you had. You still have to pay the rent and the electric bill and all the other fixed costs that you have, and you have less from each sale. So you have to do a lot more sales to get back to the point where you have enough of that margin to cover all your fixed operating costs. And what invariably happens, we look at top line, we get all excited. When you talk to an entrepreneur, the first question, if you're trying to gauge their size, is what's your revenue? Yeah. Always. They have a $100 million company, they have an $80 million company, they have a $50 million, they have a $10 million company. But I could show you a $100 million company with 30% gross margin, and I can show you a $100 million company with 70% gross margin with the same bottom line, same everything, they're worth wildly different things. And why would that be? Because if you're going to buy a company and you look at, and especially when you look at trends over time, imagine you're going to buy, we have two identical companies. They both do 100 million in revenue. They both have 20 million in profit. And we're going to look at the last 3 years of those companies. And for company A, over the last 3 years, gross margin has gone from 63% to 59% to 47%. Well, revenue's grown, but 63, 59, 47. Company B has gone from 52% to 56% to 58% gross margin. You can only buy one of the two. They're both 20 million in profit. So let's say 100 million revenue, 20 million profit. We're going to spend about 100 million to buy them. You can only buy one of the two companies. Which one do you want to buy?
Yeah.
The one with rising gross margin.
Yeah.
Because you know when you come in, if you invest dollars in marketing and sales and all the things, because margins are going up, you're going to get more incremental value out of each sale. Company A very likely has traded margin for revenue growth over time, and their margins are on the decline. If that trend line continues down, ultimately your gross margin erodes to a point where you're at break even. You can't be profitable anymore. And we talk about companies are valued based on the past, the rear view mirror, but really sellers want to value it based on the future, and buyers are thinking about the future even though they don't like to talk about it because they want to value it on the past. If the future is declining gross margin, there's not a lot of value in that company. If the future is, wow, gross margins are improving and I can make them even better by putting, more dollars into growth, that company's way more valuable in the long run. So understanding pricing, understanding margins is like, it's not only a nice to have for an entrepreneur, it is an absolute must. It's almost a fundamental responsibility. If you're going to run a company, you have to understand the margins, or you're literally flying the plane totally blind, and you risk, running into something really, really bad if you don't get how gross margin works in a business. It's a boring topic. It's not talked about a lot. It's really hard to make interesting even explaining it to you, but I will just say it is fundamentally critical to get gross margin at an intimate level in
And
a
it's
business.
exciting when you dig into it. Once you dig into it, then it becomes exciting.
Well, it makes confidence around pricing strategy so much better. Like, you can be really thoughtful about pricing and discounting. Like, discounting for a lot of entrepreneurs is like the fast train to being out of business, because it looks good because you drive top line revenue, but you're eroding margins. So now you can't cover your costs, and you wake up one day and you're looking at each other trying to figure out what the hell just happened. Like, where did all the profitability go? Our revenue's way up. And every time you start digging in, you're like, oh yeah, well, we traded margin by discounting for revenue. Yeah, it's a looming disaster in a lot of businesses right now. One more interesting thing, and this is one of those dirty secret private equity things, they don't come right out and ask a lot about gross margin, but I will promise you the very first thing that analysts look at when they get financial statements for prospective portfolio companies for private equity, they go right to the gross margin line. That's literally, they don't even care as much about the EBITDA line. They want to know, are margins going up? Are margins going down? Has this company traded gross margin for growth, or have they grown healthy where because they've got top line growth, they're able to get better margins, better buying power, more efficient manufacturing, all the different things. That is the first thing that then they don't ask, they don't talk about it, they don't tell you, but that is the first thing they look at on financial statements. So you want to make sure that your trend line is up and certainly not down.